Thank you for coming. This is our third, I believe, presentation at Sydney, and obviously our final one for the National Roadshow, so thank you for making the time and effort to come out today. An interesting point, I suppose, in regards to the video, because I get the question a lot about you run a concentrated portfolio, and everyone asks, well, it's obviously very risky. The perception out there, a lot of our competitors run 50, 60, 70, 80 stocks, but I think, the very simple analogy I use, and I use it with the investment team, if you think about it, and it's very simple, is if you can find a stock such as M&F or something that continues to comp, your shareholder returns, I think if you look at that stock over 7 years, it's comped at almost 40% per annum. If you think of, if you can make that 10% of your portfolio and it goes for such a long period of time, then it can more than offset a substantial amount of risk or capital loss in what may happen to other positions. So it's really the way I look at it. It's obviously not a probabilities game, but obviously your leverage to the upside and longer term performance is significant. I think that's the philosophy we use when we set up our concentrated funds. It's about maximising long-term performance and focusing on quality, not quantity, because the ability to minimise our losses and then hopefully maximise our exposure to companies such as M&F is key, and that's hopefully how we get our long-term performance. I suppose just setting the scene, I know Jules touched on it, but it is important, and I'm sure 95% of people here have already heard it, so I'll try and get through it as quickly as I can. But what NAOS is and what we focus on doing, we are very much a value-focused fund manager. By value, I mean we invest in businesses that tend to have been around for a number of years, unfortunately, and we believe they represent good long-term value for whatever reason. A lot of what happens sometimes is these businesses go through soft periods, they go through transition stages, they go through large capex phases, and they fall out of favour within equity markets. Equity markets are very momentum driven of late, and that means a lot of companies fall out of favour for a specific amount of time, and we use that to our advantage. We believe in quality over quantity. As I've mentioned before, we only have 11 stocks in NCC and about 15 in NAC. And we invest for the long term. So, in NCC, for example, one of our holdings has been there since day dot, so that's about 5 years. To give you an example, I think we've only added 2 new positions in NCC this year, and we've exited 1. We have no interest in the index. Obviously, the big 4 banks, Telstra and whatnot, represent a very large part of the index, close to 55% of the ASX 100. That doesn't interest us at all. We're purely investing for a positive absolute return over the longer term. And all we really care about is our share price and getting it to move up over time through both capital growth and then obviously increased dividends. We focus on industrial, so we're not, I have no competitive advantage in investing in early technology stocks. I have no competitive advantage in investing in early stage resource stocks, unfortunately. I think like Warren Buffett said, I, especially myself and the other members of the investment team, we focus on 1 or 2 things and we focus on doing it well. I'm definitely not an expert in anything, so if someone asks me about a lithium stock, I'm probably not able to comment. And the last 2 points are key. ESG has become more of a focus for us, and I'm sure people in here think, oh, well, ESG, chances are it may affect your performance. But I think, especially over the last 3 years, you've seen ESG has become much more of a focus for investors, especially for some of our younger investors. And I will give you an example in here of how we believe it can actually maximise our shareholder returns over the longer term. And we'll highlight one of our new positions, which is actually a very large core position for us, and how it tied well into this ESG theme and how we feel it'll benefit that business over the longer term. Then the final one's management alignment. All of my net wealth, apart from my humble home, is invested in the NAOS funds. A lot of the NAOS team are the same. If you look at directors and NAOS staff members, we're some of, if not the largest shareholders in our LICs. And I think that's important because we live and die by our share price. So if we can get the share price to move, obviously it's a positive effect for us, but it's also a positive effect for our fellow shareholders. This quote is on the NAOS, the NAOS door as you walk in on the right-hand side, and it's been with us, I think, almost since I started the business a number of years ago. But it's important because I think a lot of fund managers are under a lot of pressure these days. A lot of people are asking, well, why am I paying, 1.5 and 20 for a fund manager that ultimately delivers me index returns? And I think the big reason why is because a lot of fund managers have large funds and they get very comfortable with running low-risk strategies that deliver maybe 1 or 2% above the index. I think what you get with NAOS when you own 10 to 15 stocks, you will get a return that deviates significantly from the index. And it's our job to make sure that deviation is a positive deviation, not a negative one, which obviously will not be the case all the time. But what you are bound to get is obviously a return that is very different to that of the index. And that's why a lot of our shareholders use our funds, because they know they're getting a pure exposure to small caps, micro caps, or even mid caps through our two LICs. And the reason why we don't focus on the index and focus on the smaller end of the market is because if you look at the returns of some of the largest stocks in the index over the past 5 years, I suppose it's been very poor to say the least. So you've really marginally got a dividend return for the big four banks. In some cases, such as ANZ, you haven't even got your dividend return over that time. In some cases, such as BHP, and they're obviously under a little bit of pressure through a large activist investor, you've actually delivered a negative total shareholder return. So this return does include dividends, and that's important. And what they all have in common, in my view, and this is why we invest in the small cap space, and I'll say small cap, but that means mid cap and micro cap, and any small business out there that's listed, is I suppose they're a victim of their size. They're a victim of their success. They get large, and as you get larger, you're forced to diversify geographically into different industries, different technologies. I suppose you lose touch with your competitive advantage. And you've seen that obviously with the big four banks obviously expanded, and now they're contracting again. Telstra's a classic example. They've spent many billions of dollars of being forced to buy early stage technology companies, and many of those have been written off. But when you invest in a lot of our small businesses, they focus on one thing and they focus on doing it very well. And what you find is that management team is very highly regarded. They have very good touch points to that business. They understand everything that's going on in that business. And you get a very good feel for the competitive advantage, and you also get a very good feel for how the business is overall it's going and the progress that's being made. We would have no competitive advantage investing in Telstra and Wesfarmers. It's much more of a macro view. And I think a lot of that time the macro view doesn't necessarily equate to strong shareholder returns. Everyone asks us how do we get to 10 to 15 stocks, and I think this just sort of paints a little bit of a picture on how we do get there. So there's roughly 1,400 stocks we could invest in technically, so anything bigger than $10 million. When you get to NCC and NAC, there's about 470 that we could invest in NCC and about 250 in NAC. To give you an example, we run an investment universe in NCC of about 55 to 60 stocks. So that's 60 stocks that we believe tick the box in regards to management, balance sheet, having a competitive advantage, have sustainable long-term returns, a good revenue profile. But ultimately how you go from 60 to 10 is it comes down to timing and ultimately being a value proposition. I can invest in lots of good businesses, but they may not necessarily make me money over time because they may be very expensive, or it may not just be an adequate time to invest in them at this time. In regards to NAC, it's an even smaller universe, and I think this is where I always struggle with. When you run 70 stocks, A, it's hard enough to own 70 stocks. B, I don't know how you could even understand what they do or have any intimate knowledge of the value proposition. So I think what you get with us is, yes, we have a small number of stocks, but we understand them extremely well. We can tell you what the value proposition is, what our suppose understanding of that business is, and how we believe it'll bring us good, solid, long-term shareholder returns, as opposed to owning 50 stocks at 2%. I had my last conference call about 3 months ago. Jules got some feedback and said, one of the people who was on the call rang up and said it was boring. But unfortunately, that's sort of, I suppose that's what we're all about sometimes. I know some of the brokers in the room understand we don't tend to trade too much from time to time. But I think that's what we're all about. And I think we're a big believer, and I've learned the hard way, unfortunately, that you can find an excellent investment, and just because it goes up doesn't mean it's necessarily a sell, and you should find the next best thing. Ben will give you a good example of that. But I think once you find a good investment, I think a lot of people have run their own business in this room. Once you find a good investment, you're much better on sticking with that business if the management team's proven, if they're aligned, because over time you'll feel that the market actually still misunderstands that business even if it has gone up. And I can give you plenty of examples of that. And just because it has gone up doesn't mean it's got a lot further to go. They can expand potentially into new markets. Sometimes they're just touching the tip of the iceberg, and Ben will focus on M&F Group. But I think that's one that does highlight, the risk we take of then selling out of M&F Group and then trying to find something else and then timing back into M&F Group. We don't have any sustainable competitive advantage in that. And if we were to do that, it ultimately ruins our relationship with the company. And I suppose our understanding and our ability to speak with management, it becomes a little bit negligible, because over time we do build some excellent relationships with these management teams. And I suppose the transparency through that business that we get, I would say it's almost second to none in some cases. Just touching on ESG, and it's become much more of a focus for us over the last 24 months. And we're actually going to put a matrix up on here, and Raj especially has done a lot more work on this for us in regards to touching base with all of our investments and some that aren't current investments. But basically, we've been in touch with all of our investments in regards to quite a detailed questionnaire that touches a lot of these points, if not other points. And we were going to put a matrix up to give you a feel of some of the detailed responses that we got. But unfortunately, we get some excellent responses, and we get some responses that are probably far from excellent, and almost they refer to the annual report. But what we're trying to say is that we are making an effort in regards to this. We are proactive in this. We don't just say that we put it up here to make everyone feel good, but we do get some tangible responses, and you do get some tangible change that's been made in regards to this business. So like one of our businesses, Anero, for example. I've been down there a lot lately, but more recently last week, so they did a piece on their women's leadership group, how they're trying to get women to come up through the business and be key leaders in that business, and especially because it's a communications business. 55% of all members of that business are female, and they're making a big push and want to be especially a leader in that space when it comes to building up leaders, especially female leaders in the PR and I suppose creative space. But another good example is we've invested in a company which I'll touch on called Big River. So it's one of our new positions. It's a 90-year-old family business that recently listed, and they do two things. They distribute building supplies around Australia, and they also provide manufacture formwork or form ply. So if no one knows what that is, that goes on top of concrete when it's setting. A lot of people would ask us, and some of our more ethically focused investors have asked me specifically, well, how can it be ethical? You're cutting down a tree. We can't really see the ethical side of it. But I think when you look at that business, first of all, it's all sustainable timber. They're only one of two providers of sustainable timber or formwork in Australia. And when you look at more of the softer attributes, such as, they're one of the largest, I think they're a top 5 employer in Wagga Wagga and Grafton, for example. They've been one of the largest providers, or they provide donations to the Westpac life-saving helicopter fleet over the last 20 years. A lot of these family businesses, it means a lot to them, what they provide to the community, and then obviously the community gives back to the business, and they have a very high standing in regards to their respective communities, and we believe it provides them a significant or more softer competitive advantage, but holds that business in very high regard. And I think when we do go into some of the detail of these businesses, some of these things do make a significant difference. We don't just specifically get our heads stuck in a spreadsheet and then continue to just look at the numbers. I'll now get Ben just to touch on a few slides, and I'll be back to talk about NCC.
Thanks, Sebastian. So I'll just come in here for a couple of minutes and talk about two of the key philosophies that NAOS really believes when investing, and just how they apply practically, in this case, to the NAC portfolio. Hopefully NAOS can find a stock that we hold forever. We have found stocks that we still own from the inception of the funds, and some of those stocks we don't have intention of selling anytime soon. But I guess the point behind this is that we like to take a long-term view, and really buy a stock and stick with it despite the ups and downs that you see day to day. And a good example of that is M&F Group. So we purchased M&F for the first time at the beginning of 2015. The share price was $2.94. Now you can see over the course of the last couple of years that it's obviously been a reasonably volatile ride over that period. But one thing has been certain in hindsight, insofar as the earnings of the business and the trajectory of the business underlying the stock price has only gone one way. And you can see that over a longer term period, but certainly day to day, this share price, obviously fluctuates a great deal more than that. Now, some of you are probably thinking, what does M&F do? So M&F is they're a leader in voice over internet protocol. Half of you are probably thinking, well, what is that? And I'd suggest that those half of you have probably used it before. So the best example is, think about if you're overseas in a hotel and you want to make a phone call back to your loved ones at home. Your options are either send an email, or you can make a phone call using the traditional landline method, which will cost you X amount per minute. Or you can use, take out your mobile phone, log into the hotel Wi-Fi and use an app like Skype or Apple FaceTime. And really you won't pay anything if you get the access to the Wi-Fi. So that is voice over IP. And not surprisingly, telecommunications is very much going that way purely because of the cost efficiencies of doing so. So M&F, you can see over the course of that time, it's up a little over 100%. There has been certain periods, over the course of those 2 years where the stock looked expensive, or we've had a broker call us telling us it's run too hard and we need to sell out. But our ability to be able to buy in at $2.94, sell at $4, buy back in at $3 and ride the rest of the way is non-existent. We aren't able to time stock markets that effectively. So really for us, we need to take a 3-year view. And that 3-year view is premised on the fact that if we can generate a 20% return each year for 3 years, that's our investment hurdle to invest. So that return might not come in the first year, it might not come in the second. It can be varied across the course of those 3 years. But one thing's for sure, it's often not a smooth ride. And the second philosophy that Sebastian mentioned was management alignment. So this is something that not only that we seek out when looking for an investment, but also something we believe in heavily ourselves. Sebastian mentioned that NAOS Asset Management is one of the largest shareholders in both of our LICs, and the portfolio team, as well as the wider team amongst NAOS, also has a decent amount of our wealth invested in NAOS as well. So I think I've sort of found over time that nothing incentivises a management team more than having their money on the line alongside shareholders. And you can see on the right-hand side there the 1 year total shareholder return of these companies, and the shareholder return over a longer period of time is also far greater. So the first one there, I've mentioned M&F, René Sugo and Andy Fung still own 35% of that business. It's now capped at $400 million, so 35% of $400 mil is a really big chunk for those guys, and it's outside of that they don't have a huge amount of assets, so it's very meaningful for them to have that position. Smart Group's an interesting one. We came across Smart Group about 3 years ago, and the way we came across it was we noticed that 2 directors, being the MD and the chairman, stepped into the market using their after-tax money out of pocket and bought almost $5 million worth of shares on market. Now that was an event that really made us sit up and take notice, and that was the share price was about $2.90 then. It's now $10. So you can see, those guys having their money on the line and truly believing in their company and their strategy has paid off for not only them but the shareholders who invested alongside of them. And finally, the final one, Moelis. I used to work for Andrew Pridham at Moelis, so I know just how much of a capable operator he is. But he's got 17% of that business, and I know that a lot of the staff members of Moelis combined own about 80% of the entire company. So, nothing gives us more comfort, particularly when taking a concentrated position, that the staff members and the management team are there with us as well. So with that, I'll hand back to Sebastian, and I'll come back up in a moment to talk about NAC specifically and some stocks we're invested in.
I think Ben makes a good point. I know we've spoken about M&F a bit, but you go back and look at the annual report, and you look at René Sugo. I think he pays himself $200,000 a year, and I don't think that his salary hasn't changed now for about 3 years. So he's a very humble guy. A lot of his net wealth is tied into that, obviously that share price, and he built that business from scratch effectively as an engineer. I think he was the second employee. Obviously, we are not macro managers, as I've said, but I think it does help shape your portfolio a little bit, because you don't want to be investing something where there's a significant headwind definitely from a top-down strategy. So I just wanted to touch on, one of the key themes we're seeing, and I know it has been in the newspaper a little bit lately, but I think we'll give you some just key stats and how we're getting our exposure to this specific theme. And obviously, the first one, everyone talks about interest rates and the effect of, interest rates do rise. And we've been saying this for a couple of years now, and obviously they haven't gone up, but especially when rates go up initially, it's not necessarily a bad thing. Rates go up for obviously good reasons initially. You talk about the consumption in the economy, utilisation rates, employment rates, wage growth. Initially, it's quite a good thing. So I think, if rates do go up in this country, I know people focus on the negative, mortgage rates, mortgage repayments, but fundamentally from a business point of view, it's actually quite a positive thing. And one of the, over time rates will go up, but one of the key drivers of the economy over the past, 6 or 12 months that's significantly changed is business investment. So, I give the story a lot. One of the worst investments I ever made was a mining contracting business many years ago that had a very large deal with BHP out of the Hunter Valley. And, I remember they did a lot of maintenance work and rehabilitation work on the CAT fleet of those trucks. So obviously it hauls the coal up from the bottom of the mine to the top. And you could go to that mine and you could see 15 trucks that are basically broken down sitting on the side of the mine. And it was the BHP's view that they were better to sit there because they didn't have the budget to fix them. So they were focusing on productivity and cash flow as opposed to maintaining a fleet that was of a high spec. Obviously, what that meant for the mining contracting business was it almost went to the wall because they couldn't make it through the next year, and those orders kept being deferred. That's clearly changed. I think you talk to a lot of the contracting businesses today, and they're seeing a lot more sustainable orders coming through, and that backlog's been following through over the past 12 months and probably most definitely for the next 12 months. But what's also driving that, and I think this chart sort of highlights it a little bit, is if you look at construction and more specifically investment in infrastructure, it is significant. And on the next slide, it talks about the size of the infrastructure spend in this country being 1.5 times the size of the mining boom in Australia. And I think when you highlight that, people start to think, oh well, everyone thinks the mining boom was obviously the be all and end all. But I think when I drove past WestConnex the other day out near Haberfield, and you see the size of that entry, you think this project it's a serious amount of money that's going into the ground here, and it does put it in perspective. This is a chart that we first found in the old Leighton's, or what is now CIMIC, the large public company, and it highlights the major transport infrastructure projects in Australia out to 2023. And you can see by 2020 and 2021, the spend per year will be close to $17 billion. And I think when you look at, you can see WestConnex there being that green one right in the middle, being the largest project. But you can see the amount of spend that's ramping up over the next 2, 3, 4 years is significant. And it doesn't include things such as the national broadband network, which has been in the press a lot lately. And you think about the spend on that. And I think if you talk to a lot of contractors, and obviously we own a large position in a company called BSA, it's hard to find people. They're finding it hard to find good staff, and I guarantee you they're not alone. I think a good example is, 3 years ago when Leighton's was taken over by the Spanish, everyone thought it was one of the worst stocks in the market. Unfortunately, it's been one of the best performing stocks in the market ever since. And and a big reason for that is because of this spend. There's a significant amount of money going around Australia, and I think people miss the point because it's so scattered. But when you cumulatively put it all together, you see that you do want to have some exposure to this thematic. And the way we do it is, obviously we've made a very large investment in a company called Big River. I can almost guarantee no one knows about it in this room, maybe one person. And the reason why no one knows about it is because it was an IPO. Obviously we very rarely invest in IPOs. It's very illiquid. The founding shareholders in there I think own about 70%. To give you an idea, the top 20 own about, it's almost 90% or 92%. So it's very much trade by appointment. But this is a business that's been around for 90 years. It has a lot of goodwill, as I said, in the community and with their customer base. To give you an idea, their CEO and general managers have all been in there for at least the last 7 years. Some have been there for closer to 20 years. They know this business very well, and it means a lot to them. The CEO has a significant amount of his net wealth tied up in it as well. They came to the market because they were looking to acquire businesses, and there's a big opportunity in the building supply space where there's a lot of baby boomers looking to get out of the industry, and unfortunately their kids don't want to take over a large building supplies business because it doesn't seem attractive enough for them, or they want to get into tech, or they want to do something else. What that means is they have these owners have very little people to sell to. And Big River sees this as a significant advantage for them, and they've made their first acquisition in Burleigh Heads about 3 months ago, and we think they'll make a number of other acquisitions. And what that means is it gives them a large national footprint. They can bid on some very large types of projects. So think Gold Coast Hospital, for example, because they have the balance sheet, they're a listed company, they source local products. It gives them a big in as opposed to a lot of, suppose, global companies that are from offshore. The second one is Saunders International, and like Big River, it's been around for a long time, about 60 years, but Saunders has been listed for a lot longer, so you can go and have a look at their history. Once again, a register that's tied up with a lot of the founders, and some of the founders have been there, I think, close to 30 years in some cases. They make and manufacture tanks or storage tanks. Nothing too attractive about it or out of the box. But the thing that attracted us to this business is they hired a new MD. So that was the first sort of new blood that's come into this business in many years. We knew the MD from a previous life, and he's very highly regarded. He made an acquisition just out of Newcastle, a business called Civil Build. obviously civil, you think of infrastructure. They're a big fabrication business and also a bridge maintenance business. So they obviously may do a lot of work with WestConnex, and you talk to some of the fabrication manufacturers, for example, and they're saying WestConnex alone will take us up for the next 3 years, just from a supply point of view. Then when you look at the amount of bridges around Australia and the amount of work that needs to be done, because a lot of them are timber, you think, well, again, there's another significant tailwind. And there's very few ways to play this in the ASX because a lot of these companies have been taken over. So Seymour White, for example, a very well-known business, was recently taken over by a large French business. A lot of global companies are looking at Australia as a key market for them because of the amount of spend that's going to occur over the next 7 years, and they don't have any exposure. So ultimately what that means is the amount of quality listed companies left is minimal. Just touching on this, and we've put this slide in because sometimes there is a little bit of an issue in regards to people understanding the difference between the two LICs. So NCC is very much a microcap focused LIC. So our average market cap is about $100 million, to give you an idea. Our smallest company would be $20 million and the largest would be M&F. I think when people look at micro, small, mid cap, everyone thinks of market cap. What they should be thinking about is actually liquidity. It's, you can be $1 billion business. You look at Moelis, for example, it's probably a $700 million business. So people think that's large. But when 80% of the stock doesn't trade because it's staff, it's treated as a micro cap. So in my view, market cap's almost irrelevant. It's all about the liquidity profile. And because we are a closed-end fund, it gives us a massive advantage because we don't suffer from applications and redemptions. We can take big long-term positions with conviction and not worry about people pulling the money out of the funds. NAC is very much focused on that small to mid-cap space. So you see something like an M&F go from 100 million to 400 million, it can naturally fall into the NAC universe. So it's a natural progression for us to move into those slightly larger businesses, albeit they may not be as liquid as many of their counterparts. Everyone likes talking about performance. So I'll start from the right, because obviously they tend to look better on the right and then work backwards. But I think the important thing is we focus in NCC especially to do 20% year in, year out. People have seen me talk a lot probably, and sometimes we can have a year of 4% and the next year can be 35%. It's just the way it goes. When you run a concentrated fund, I can guarantee you we sort of bang our head against the wall a little bit because sometimes we believe they've made a lot of progress, but unfortunately when you invest in these businesses, the Renes of the world or Cameron who runs COG, I can guarantee you they have no interest in marketing their business. They could not care less about the stock market. They could not care less about institutional investors. And what that means is, a lot of fund managers won't make the effort. And that leaves NAOS there just slowly soaking up a lot of stock over time and sort of hoping that it does make progress over time. And it feels like we went through one of those years. Our two biggest positions were probably our two worst performing positions. But pleasingly, a lot of our smaller positions, such as CML Group, which I'll touch on, actually made a lot of progress. And there's some of our more long-term positions. But at least we can hand on heart say we're still yet to have a negative financial year or calendar year return. Dividends, they continue to track higher slowly. And I think it's important because when you do look at LICs, it's important to look at the reserve amount and what a company can pay out. We have about 2.5 years of reserves in NCC. I think if you look at a lot of other LICs and you lifted the hood up, you'd see they'd be running a lot more skinnier. So we could have paid much bigger dividends, but I think as a board we're very focused on building a sustainable dividend profile as opposed to just paying a large dividend for the sake of getting the stock at a big premium to NTA and then issuing an awful lot of stock, which means that you're then stuck from a reserve point of view again. The historical shareholder return breakdown, everyone asks me how does performance equal shareholder return, so we've done it for you. NTA, so we're trading at a slight premium. The dividends we've paid out since inception, so it just went X, so you'd have to add that on. The options and what they were worth, we don't have any options anymore, thankfully, and we don't plan to have any in the future. And then obviously the franking that we've paid out. So you can obviously make what you want from this information and derive your own shareholder return. Just quickly on 3 stocks, and I'll keep this quite short. So 2 stocks that have worked and one that unfortunately is yet to work. CML Group was our top performer for the last 12 months. This is a business that unfortunately initially went through a very heavy restructuring phase. It got a little bit ugly there for a little while, but to their credit, and because they own a lot of shares themselves, they reinvested in the business, I suppose, hid from the market for a long time. Hired some excellent staff from larger corporations that were proven in regards to risk management. As background, this is a factoring business. So they do financing receivables books. So if you're a large company and you deal with Telstra will pay you in 120 days. Unfortunately, that tends to stop the growth in your business because you're waiting for Telstra to pay you over the next 3 or so months. What CML Group will do, they'll finance up to 80% of that for you so you can get the cash today as opposed to waiting for 3 months. The big issue for CML was risk management and systems, and what they had to go away for a number of years. And as I said, they hired some key staff, especially in regards to compliance and risk, and then brought in some key business development people to help build their book. And now they're the second largest listed player, and they'd have to be a top 3 player in the general market. So the largest being Westpac, for example, and NAB do a lot. Then Scottish Pacific, which is a large listed business, and then CML. Secondly, BSA Limited, everyone would know it's one of our largest positions. And I suppose the key for us is they had 2 legacy issues, one with Enra Hospital in Adelaide, which has been probably a financial disaster for everyone, and also the Office of State Revenue, which was both liabilities which unfortunately Nick inherited. Over the last 3 years, it's taken him an awful long time to get rid of those issues, but pleasingly they signed a deed of arrangement with Leighton's, who was the head contractor in Enra, and then also they've done a deal with the Office of State Revenue for a payment terms in regards to an outstanding liability. What this means for them is they've paid their first dividend in, it must be 5 years. It allows them to focus on growth, allows them to focus on margin and new work. So obviously it doesn't mean much from a shareholder's point of view initially, but I think just from a confidence point of view and the ability for people to work with BSA again and focus on opportunities such as NBN is significant. And the one that everyone likes to talk about is COG, or what was AIK, is our largest position in the fund. It's a market cap of about 150 million. They do equipment leasing and they also do finance broking, so they're consolidating the finance broking space. Unfortunately, it was one of our top performers until about 4 months ago. And then over time, they've actually announced 2 acquisitions which didn't occur. And they didn't occur because they weren't happy with obviously what they found in subsequent due diligence. So we're happy with that because it shows that the business is disciplined. I think the wider market is obviously rather negative because they think obviously it's going to take them longer to grow. But I think fundamentally when you look at the CEO who bought another, I think $2 million worth of stock over the past week, this business is now a 3rd cash backed. The CEO used to run, he put Steadfast Insurance together, is a significant owner of Employers Mutual. They're very proven in this space and they're now the largest finance broking business in Australia. And I think when you go to an ANZ bank and ANZ are saying, well, if you're a finance broker and you want to finance through us, if you're not part of an aggregator, we simply won't deal with you anymore. So this provides a significant opportunity for COG to find these brokers and get them to join this group and give them obviously the benefits through scale, because the banks continue to get out of this space. They just want to be a funding institution, not a sales and distribution institution. Sorry. I'll now get Ben to touch on NAC and I'll be back for just some final questions.
So since inception in NAC, we've done a little over 16%, but that's obviously come down a little bit over the last 12 months where we haven't really covered ourselves in glory. Now there's 2 points to make here. Firstly, and quite obviously, what's gone wrong in terms of the stocks that we've chosen that we no longer hold, and I'll give an example of one of those in a moment. The second thing too is that there's a couple of large stocks which we've bought into and haven't gone, or have yet to really do anything. They've tracked down and sideways. So that's probably a common investing trait for us in terms of being what we think is, or hopefully in this case, too early on stocks, where we won't necessarily pick the bottom, but we do look out for that 3 to 5 year view. Just our dividend history, so similar to NCC, that dividend has been increasing over time, and the way that we run the fund is obviously to continue that going as we move forward. So for us, a lot of investors are self-managed super funds who require that income stream, but also the franking benefits that come with the dividend too, which help out on taxation. So that's something we're very conscious on and something we hope to be able to maintain going forward. Just the historical shareholder return breakdown. You can see in the 3rd column there that a big chunk of that has come from the options. So if you haven't owned the options or didn't have the ability to sell at the time of expiry, then you wouldn't have been able to participate in the full run rate of performance. Now, the LIC has no options outstanding at the moment, so it's a completely clean structure. So you won't see that dilutionary effect take place from here going forward. And the other point to make there is just on the dividends, we paid another 2.5 cents on top of that, which went ex-dividend on Monday. So that dividend profile is obviously growing, and you can see the franking there on the left too, which also increases as we go forward. Now, just 3 stocks within the fund I'll talk about. These 2 are both stocks that have worked quite well for us, and then I'll talk about another stock that hasn't. So M&F Group, I've really touched on. Obviously it's been a very strong performer since the inception of the fund. The trap that we can fall into, though, is anchoring ourselves on that 3-year time horizon that we took at the start. And particularly if a stock achieves that, the risk is then that you sell out too early. Now, we take a view on M&F at the moment that from here looking out 3 years, we can still see, hopefully, what will achieve a 20% year-on-year return. So it's a stock we continue to hold, and it's a stock we see a bright future for. Elders is one we haven't held for as long. We bought Elders at the start of this year at around $4. And at the time, I said there was 3 things that they needed to do for the share price to re-rate. The first was to get rid of their live export business, which they've done. The second was to clean up the capital structure of the business, which they've done. Third thing was a resumption of their dividends. Now, they report their earnings in a few weeks' time, and we're very hopeful that they'll pay a dividend out of the earnings. The balance sheet's in very strong shape now, so they are in a position where they can acquire other businesses. And Mark Allison, the CEO, who's come in and done an incredible job with the turnaround, his focus and his ability to allocate capital is really the reason that Elders has done so well from what looked like a very bleak time where the company almost went bankrupt about 5 years ago. So from here, it's trading still at a significant discount to peers and the rest of the market. And we think that the earnings going forward will have less exposure to the agricultural cycles that you often see with some of these stocks. And thirdly, a stock that didn't work for us, Virtus Health. So Virtus is a leader in IVF care. Now, the issue with Virtus was at the time we invested, there was a new player coming into the IVF market being primary healthcare, which I'm sure a lot of people in the room know of. Now, that was something that was well known in the market. We went out and spoke to competitors of Virtus. We spoke to independent IVF operators who all had the same view that a new entrant who was coming in and undercutting the cost would be less successful than what everyone thought. IVF is obviously a process that you go through where the end result and the statistics on that result are certainly something that matters greatly to the patient. So we took the view if someone was coming in and offering the same service at a lower price but having a lower success rate, they wouldn't have much success in taking market share from Virtus. Now, when there's a company going through such change in industry dynamics, it can provide a lot of opportunity, but it can also be a trap too. And we found that was the case with Virtus. They had to downgrade their earnings because of that new entrant coming into the market. Since then, we've seen their main competitor, Monash, which is also listed, one of the key doctors from there has left as well. So it's an industry going through a lot of change at the moment. And because of that, we've sold out of the stock because we don't really see ourselves as having any edge in picking how that change will play out. And just finally, the number of shareholders that we have across both of the funds. So why this is important, you can see there at the start, it's obviously tracked up quite steadily over the last 5 years. So when running a listed investment company, you've obviously got the underlying portfolio performance, but then there's the share price as well. And you'll find that often, they don't often track one and the same. So with the amount of shareholders that we've got over time, we've found that the NTA discount has decreased, and we've found that the share price has really caught up with the monthly NTA numbers that we put out. And that's important because not only is it important for the portfolio to do well, but if the shareholders aren't participating in that performance as well, then it's obviously an issue that we need to address. So the amount of shareholders has certainly done that, and we hopefully for us and shareholders of both LICs, that can increase over time.
Thanks again for taking the time on a busy day and obviously a busy AGM season, and we'll see you next year. Thank you.